When you look at inflation, it's a major concern for the savings industry, and it's probably our number one focus in terms of how we advise clients. What I think clients really need to take into account is that when it comes to savings, you want to make sure that the type of return that you're getting from your product ultimately and over a period of time beats the inflation rate. The reason is that if you add it up, let's say over a 5 to 10 year period, if your investment is not keeping pace with inflation, then systematically the purchasing power of that investment is going down, and that by the time you need to utilize that investment, you'll find that it's worth a lot less than what you anticipated when you took out the investment to start with. And it's one of those forces that most people underestimate at the outset. In other words, one simply assumes that a couple of percent of inflation here or there doesn't make a significant difference. But simply adding 2% more to an investment, or even 1% more over a 20-year period, can literally be the difference between a comfortable retirement and a retirement that is under significant pressure. The other aspect that I think gets missed in South Africa is that when you start to retire or look to retire, your inflation rate actually changes. And that's because your basket of goods, the stuff that you're buying on a monthly basis, changes significantly the older you get. And in this country, it just so happens that the inflation rate for pensioners or for retired individuals ends up being roughly 0.5% to 1% higher than the national average inflation rate. And that's partly because retired people spend a lot more proportionately on medicines and on medical care, and the inflation rate for medical aids tends to be closer to 10% than it does to 6%. Which means that when you enter your retirement years, the type of money that you have to put away needs to go up because your cost of living has actually gone up. And the type of return that you need to get from your investment equally needs to rise by roughly 0.5% to 1%, sometimes a little bit more, to meet your needs. And getting 1% more out of your investment is really quite a difficult thing on a perpetual basis without you taking on significant risk. So the key question becomes, how do you plan for your retirement so that your investments consistently beat inflation without you taking on a huge amount of risk of simply putting all of your money into the equity market, for example, or into some other instrument which may appear fairly safe at the time of you undertaking that investment, but over a long period of time may prove to be extremely volatile or end up losing you money. And for us, one of the key thoughts that you've got to factor in right now is that we've entered a world of negative real interest rates, and we've been in that world for some time. By that I mean that simply the inflation rate in most countries, including South Africa, is persistently above the level of interest rates. So if we look at South Africa, our repo rate or a money market rate is around 5%, the inflation rate is closer to 6%. That immediately tells you that you put your money in the bank, you are losing at least 1% a year relative to the cost of living, and even more if you're near retirement. So it's not an option under current circumstances. So you've got to find a vehicle or a mechanism that will allow you to get a slightly higher return, let's say around about 7%, that then ensures that you're beating inflation of 6% without taking on a significant amount of risks. And the bizarre thing is that those instruments exist. They actually exist very readily, and they tend to be housed in something called income funds. And what income funds do is that they invest in near money market type instruments. They just slightly up the yield curve. Yes, they do include more risk than putting your money in the bank, but the amount of additional risk that you take on as an investor is negligible in relation to the comfort of beating inflation over longer periods of time.